This is Ron Sweet, Professor of Finance at the University of Texas at San Antonio, and this is my view of what the essence of finance is. And I break this into four parts. First, the rules of finance, which is my view of what is the goal of finance, what are we trying to accomplish in finance. Secondly, is the tools of finance. Once we know what we're trying to accomplish, what our goal is, what are those tools we use in finance to accomplish that goal, and I'll talk much about the most important tool of finance, which is discounted cash flows. And then I'll talk about other tools of finance, which are referred to as the jewels of finance. Those tools of finance which have gained prominence in finance and are used quite extensively in all areas of finance. And then finally, for no better word, I say fools of finance, just so it rhymes with the others, but also just to give some examples of where finance historically has failed very, very poorly, and to discuss why those failures might have occurred. So let's start with the rules of finance. That is the goal of finance. And in finance, we start with our inputs, which is we want to use financial information, tools, and models as our inputs. And this can include all kinds of types of information. We usually start with the assumption that we're talking about accounting information, which is absolutely true. We do use a lot of accounting information, but it's much broader than that. It's really any information that gives us some insight into the future of economic growth, the future of corporations, the future of industries. And so not just historical accounting information, but as one article I show in class often is an article written by Robert Arnott, which talks about the impact of demographics on markets and on growth and on returns. And his argument is the age and makeup of populations, how many young workers there are, how many retiring workers there are, what is the population growth, what's the educational system, that has a huge impact on countries and industries. A book I often reference is a book called Why Nations Fail, which the authors go into quite a bit of historical analysis on why some countries seem to achieve greatness and other countries have occasional periods of greatness, but then just seem to always fall back into periods of very low economic growth. What are those characteristics of those countries that do well and those that do poorly? And obviously there's a whole slew of economic information. If you go to a website like Bloomberg.com and look at the economic calendar, you can see the economic data on a daily basis that hits markets and hits corporations for them to understand what is going on in the world around them. So much information that we have at our disposal, almost more information than we can handle or process. We take that information and we apply it in the tools and the models to try to accomplish our goal in finance. Those tools can be Excel models, Excel spreadsheets, algorithms. They can be theories of finance that we'll talk about in my finance classes, like the capital asset pricing model. Just theories and models in finance that try to give us some insight into what all of the data information we have is telling us. So what do we do with this input? Well, our goal is to search for and implement what I have in quotes here, optimal enterprise solutions. And the reason I have the word optimal in quotes is because it's an almost unattainable goal. The word optimal means the absolute best alternative available. And the reason for that is as soon as we find a solution that we believe is optimal, assuming we have all the information we need, the second we find that optimal solution, the world changes, interest rates change, inflation changes, corporations go in and out of business, and that optimal solution that was optimal 10 minutes ago now may no longer be optimal. And that even begs the question if we even have the ability that get so much information that we can really be confident that we found optimal solution. So I remember discussing in my past in finance, the professor who is the head of statistics at Princeton University. We used to talk on a regular basis about this idea of finding optimal solutions. And I told him my frustrations of trying to get the models calibrated to find these solutions. And he finally said, Ron, just forget about the word optimal. Our goal is not finding the absolute best solution because that's illusory. It's impossible. What we're after is finding the better solution. Look at where we are today as a corporation and use financial information, tools, and models, and find a better solution. And then once you find it, implement it, and then start all over again and look for another better solution than where we are today. So what are those solutions we're looking for? Well, in finance, we're looking for solutions that balance expected value with expected risk. That is the key to finance. So in finance, we're striving to either increase expected value, reduce expected risk, or some combination of the two. And we're really, anytime you're talking to someone in finance, what they are hearing when you're explaining a project or some opportunity, what they're hearing is terms that they can interpret as either insights on value or insights on risk. That's how we in finance view the world. We want to be paid for taking risk. And if we get paid too much for taking risk, we'll take as much as we can get. One of my my first hire of a finance student, when he came into the job, I told him we had a particular portfolio that had extremely high expected returns in the mid-20s, but extremely complicated transactions with a lot of risk, and we really did not have the time to sit down at each one of these transactions and really assess all of the risks. It was just too much work for the size of the transaction we're looking for. So I challenged him to find a way that we could get access to these investments, but be able to offlay a large amount of the risk. And he worked and he found a way that we'd have a partner who would take almost all of the risk of the transaction and to give them, to pay them for taking all that risk, we gave them some of the returns. So instead of having an expected return of, say, 24%, our expected return fell to 21%, but the risk almost disappeared. Very, very low risk. It wasn't zero risk, but it was very, very low risk. That was an extremely high return, 21% expected return with very, very little risk. So we told that particular vendor, bring us all of that security type that you can bring us. We'll do all the legwork on the contracts, and we'll be a very quick implementer of this because it has a very high return for very low risk. However, on the other side, if we are not getting paid enough to take a risk, we are going to avoid that risk, hedge it, reduce it as much as possible, and we might even, what we can do in finance, which is a very interesting concept in finance, we might actually be able to short that risk. In shorting a risk, what that means is we actually sell something that we do not own. And when we sell something we do not own, we actually borrow that from somebody else, sell it, hope the price of it falls, we then buy it back, and then return it to the person we borrowed it from, and we get to pocket that difference in those two prices. Well, let's think about this concept of valuing risk, but let's think of it as a map. A map of all the possible opportunities, where north and south is our measurement of value. Higher north is more value, further south is less value, and in east and west are a measure of risk. The further west you go, the more risk there is. And let's put this across the map of the United States and ask, where would you want to live in this type of map of value and risk? So obviously you'd want to live as far northwest as you can, as you could, maybe the state of Washington, as far north as you can. And that would be the wonderful place to live. Why? Because you're getting very high value with very low risk. Unfortunately, those opportunities that are very, very far north are what we call utopia. They don't usually exist. Why? Well, because if there's high value but very low risk, everyone is going to want to be there, want to live there. They want to buy that investment. And what happens when everyone demands the same investment because of the high value and low risk, it will cause the price of that asset to soar. And the price of the asset will go up so high, be so expensive to buy that asset, that its expected value will decline, because the higher we pay for something, the lower our return is going to be. And the expected value is going to decline so much that it's going to be much, much more in line with its risk. We have assets that have low expected value but also have low expected risk, and that's the expected case. Very rarely will you find very high value with low risk. On the flip side, let's say the Florida Keys might be the worst place to live in this conceptual map, because very low expected value but very, very high risk. And there's some places in this grayed out area, in this pink area, that some are better than others, but still you can almost always do better. Well, these assets also don't exist for very long because everybody will be selling these assets. Once we figure out that they have low expected value but have high risk, everybody wants to get out of them. Everyone wants to sell. The price will fall dramatically, and eventually the price will get so low, the security becomes so cheap that its expected value is actually very high. It will become a good investment, which means assets that are high value and low risk tend to fall south because so many people demand it that its price gets very, very expensive. And in assets that have very low expected value with high risk, their prices will tend to fall, which increases the expected value going forward, and they will go up north. And what we talk about in finance is a concept developed in the 1950s by Harry Markowitz, a Nobel Prize winner in economics, the concept of efficient frontier. That is, all of those available opportunities tend to gap around this frontier where low expected value opportunities also have low expected risk. High expected value opportunities also have high expected risk. Why? Because markets are efficient. Market will price securities such that the price, the security gives you an expected value that's consistent with the expected risk of that security. Does not mean there's not some securities every once in a while that get mispriced and are great opportunities or really horrible opportunities. But for the most part, it's the assumption that markets are pretty efficient at pricing risk. So this begs the question, I have not defined yet what is value. And I haven't defined what is risk. I have defined that they tend to be somewhat correlated. Higher expected value tends to be correlated with higher expected risk. But what do we mean by value and risk? And in finance, we tend to have pretty good consensus on these definitions. By value, what we mean is expected future cash flows. I used to have one of my first bosses in finance. He would always say, you do not buy groceries with net income. You buy groceries with cash flow. Net income's a nice measure in accounting. It may give us some insights in future cash flows, but it's ultimately a cash flow we need. And that's our measure of value, which means our definition of risk is a possible deviation from that expected cash flow. If we're expecting an asset to pay us $500,000 in 6 months, that would be our expected value, our expected future cash flow. But what's the risk that we will not get that $500,000? Maybe we only get $200,000. Maybe we get zero because the firm goes out of business. So those are our measurements of value and risk. Well, is there a way we can combine our concept of value and a concept of risk all in one number? And yes, in finance we do that. And that's our most common tool we use in finance, which is the discounted cash flow. With the discounted cash flow, we project future cash flows, which is our measure of value, and then we're going to discount those cash flows. That is, put them in today's dollars by discounting them at a rate that reflects the risk of the cash flow. The higher the rate we use to discount the cash flows, the lower that those future cash flows will be worth to us today. The lower risk that we use to discount those cash flows, the more valuable those future cash flows will be to us today. So there's an inverse relationship between discount rates and what we think the value of an asset is in today's dollars. And the discounted cash flow, the calculation of it follows a very, very common process. We do this very frequently in finance. The first thing we do is project future cash flows. So there is a saying in finance that says finance is forecasting. And we do a great deal of forecasting in finance. Once we forecast those future cash flows, we then need to select a discount rate to discount those cash flows, to put them in today's dollars. And that discount rate we select, again, will reflect the risk that we perceive to those cash flows. We then obtain the present value, the discounted cash flows. We sum up all those discounted cash flows. That tells us what we think those future cash flows are worth to us today. That is the intrinsic value, the value to us of those cash flows. So that's our view of this particular opportunity, this particular investment. However, there's others out there that are always also looking at this particular transaction. And you take with a stock. If we look at Apple stock and we say, wow, we think Apple stock to us today is worth $500 per share. That would be our intrinsic value. When we go out and look at its current market value, maybe it's $600. So we think it's worth $500, but the market price is $600. We say, you know what? We don't think Apple is a good buy. We only think it's worth $500. We'd have to pay $600 today if we bought it in the market. That's a bad deal. So we compare our intrinsic value to the current market price. The encouraging thing in finance is, in order for us to be successful, we do not have to be exceptionally superior to everyone else, because we're not competing against the absolute best in finance. We're competing against the average, because that's what the current market price is. The current market price reflects the average opinion of thousands and thousands of investors. So if we're just slightly above average in our forecasting, in our determining discount rates, we can be very successful in finance, because we get to buy at the current market price, which is just the average of many opinions. So once we have our intrinsic value, the value we think something is worth, a future cash flow is worth, compared to current market price, then we can make a decision. If our intrinsic value is greater than market price, we're going to invest in that asset. Otherwise, we'll sell, short, or avoid that transaction. Now, I mentioned this in terms of stocks. This same process works if you're looking at bonds. A bond is when you loan someone money. It also works if you're a corporation, you're trying to make a decision about an investment, such as you might be deciding, do we invest in this software package? Do we invest in these buildings? Do we invest in this new process? Well, we look at that software package and we say, wow, that software package, we look at if we implemented the future cash flows and we discounted back, buying that software package, the value to us would be $20 million. And then we go to the vendor, and the vendor says, well, we'll charge $25 million for that software. Or you say, well, the software is worth $20 million for us. It would cost us $25 million to buy it. That's not a good deal. If we did that project, if we bought that software, it would actually reduce the value of the firm by $5 million, because we would pay $5 million more than what that software was worth to us. So we use this process in many applications in finance. So how do we determine that discount rate? Step number 2. Well, in finance, we have a discount rate, which is a very common formula. There's many different iterations of this formula, many different theories on how they exactly get it, but they all come back to the discount rate we use starts with what we call our risk-free rate, and we add to that a risk premium. The risk-free rate is we go throughout the entire globe and we look for an asset that has what we consider to be the lowest risk possible. And that is usually a U.S. Treasury security, loaning money to the U.S. government, considered to be the lowest risk asset in the world. But there's many treasuries. There's 1-year treasuries, 3-year treasuries, 5-year treasuries, just many of them. So which treasury yield, interest rate do you use as your risk-free rate? Well, in finance, we want to find a treasury that has a maturity that is comparable to the horizon of cash flows we are evaluating. So if you're looking at a 5-year project, then you use a 5-year treasury as your risk-free rate. And then we're going to add to that a risk premium, that extra return that we need to compensate us for that risk of trying to get those cash flows. What risk do we perceive in realizing those cash flows? If we cannot make a return of the risk-free rate plus that risk premium, then we should not invest in that particular opportunity. We'd probably be better off just buying the risk-free asset, because we know we're almost for sure that we will get that return, the risk-free rate return. We want to make sure if we do something riskier than that we get paid an extra return, a risk premium for taking on that risk. So each security, or each opportunity has a different level of risk. Our confidence in projecting cash flows is very different for different securities. So good finance professionals are those that excel in forecasting future cash flows and coming up with the correct discount rate. And selecting the correct discount rate today is much more difficult than it was 20 years ago. It used to be a very straightforward process. Where you went to get the numbers used to be very straightforward, especially in finance classes. It's a very quick operation. But today it's gotten much muddier and much more difficult. And the reason is because the world itself seems to be conflicting in terms of whether it's getting riskier or less risky. And a lot of it has to do with globalization. When we look at globalization, the world is so much more interconnected. Much of the world is moving more to free markets, and we're seeing the rise of China, the unwinding of the USSR. We're seeing the growth in Asia. We're seeing Latin American countries, many of them breaking out. But at the same time, we're seeing new conflicts, new challenges. And because of that, what we notice is the world seems to have periods of incredible stability and then followed by periods of incredible risk, such as in the 90s, incredible stability in the 90s. And then we had a large sell-off in markets, a very period of great volatility in 2000 and 2002 with the dot-com crisis. That was followed by a period of incredible stability from 2003 through 2007, followed by an even bigger crisis in 2008. And this may be the pattern going forward, 4 or 5 years of incredible stability, followed by a huge market sell-off and great volatility. But we really don't know. Is the world getting less risky or more risky? And is it maybe a combination of the two? Well, if that's the goal of finance, is for us to understand this future cash flow and get an intrinsic value of what we think something is worth today, are there other tools in finance that help us with that process? Are there other tools in finance that help us in forecasting cash flows so that we can get insight into value and or help us understand risk, get that correct discount rate? And there's many of them. Let me show some of the most common ones that we use, the most popular ones. And probably one of the most important numbers in finance is the weighted average cost of capital. The weighted average cost of capital is the discount rate firms use when they're evaluating projects, how management is doing. Essentially, we refer to the weighted average cost of capital as the hurdle rate for a firm. That is, let's say a firm's weighted average cost of capital is 7%. What that means is if they can find projects with returns higher than 7%, they should implement those projects and they will add value to their firm. If they cannot find projects that can get a return greater than 7%, they should not do those projects. They should return that money to their investors. That weighted average cost of capital is that hurdle rate that allows management to evaluate all of their decisions. Probably one of the most well-known theories in finance. It's historically it's been the most referenced theory of finance ever developed. It was created by William Sharpe in the early 1960s. William Sharpe is known as the father of modern finance. He is a Nobel Prize winner in economics for this theory. It's the capital asset pricing model. And essentially, as important as it is, it doesn't seem all that substantive. All it is a theory for coming up for a discount rate to value stocks. But that theory has a lot more components to it. Dr. Sharpe came up with this concept of systematic risk as measured by beta. And that concept of understanding risk, having this systematic and he says also an unsystematic part, gave us great insight into a great deal of finance and really has created many new facets of finance since the capital asset pricing model was first developed. Some other parts of finance, the net present value. Net present value is nothing more than a discounted cash flow. But it's a discounted cash flow. It's a term for discounted cash flow that we use specifically for projects for a firm. So we're trying to figure out incremental cash flows for a project that a firm is looking for. Buying new software, building new buildings, building new retail outlets. And so what we're trying to do is figure out if that investment of our stockholders and bondholders' money will that investment give us a return higher than our cost of capital? Some other notables. The H model. The H model is not that well known in finance, but it's getting more commonly used. And it is a discounted cash flow model for valuing stocks, but especially for firms who do not have a stable growth. It might be a firm who's growing very quickly today, but 10 years from now will be a more stable, lower growth company. And the H model is a very efficient model, very easy to use model that allows us to handle a firm that has multiple growth stages. Another tool in finance is what we call alpha, tracking error, and information ratio. These three numbers are very closely related to each other, and they are measurements we use to see if someone who's managing our money, a portfolio manager, maybe a mutual fund at Fidelity or T. Rowe Price, how do we know if they're actually adding value to us relative to the risk that they are taking on? And that's what these three measurements seek to do. We already talked about the efficient frontier, but it allows us graphically to compare different combinations of value and risk, and try to find optimal strategies. Now, the option pricing theory, one of my favorites, But a very, very different theory of finance than what we've been talking about previously. But discounted cash flows, as we mentioned, the most common tool in finance, discounted cash flows. When perceived risk is higher, when we increase that discount rate, discounted cash flows will be lower. The value of that investment is less to us because it's riskier. Option pricing theory is just the opposite. Option pricing theory relates to how do we value something that has a contingent cash flow. We don't know what our cash flow is going to be until we figure out what something else does. We might have an option on a stock, and we don't know what the option is going to be worth until we see what the stock actually does. In this theory of finance, riskier things actually have more value. Higher risk actually means more value. The best way to think about option pricing theory is to think of insurance, life insurance, auto insurance, and it's a very different field of finance. The key with option pricing theory versus discounted cash flow is because they are so different in their understanding and measurement of risk and how that inputs into our intrinsic value. It's very important to understand when you're looking at a problem in finance is to ask, is this a discounted cash flow problem or is this an option pricing theory problem? Because if you pick the wrong theory in finance, you will be pricing risk incorrectly and maybe disastrously so. A few other notables, duration and convexity, two of my favorites. They are measures of risk, but specific to a particular risk called interest rate risk. It is the risk that assets that you own will move because interest rates change. And in particular, we really think about bonds when we loan someone money. Bonds are very sensitive to interest rates, and bonds have a duration and convexity. And once we know their duration and convexity, we know a great deal about the interest rate risk of that particular investment. So it is a risk management tool that is very, very useful. Banks and insurance companies use it for something called balance sheet immunization because they have assets and they have liabilities that are both very sensitive to interest rates. And by using duration and convexity, they can control the interest rate risk of their assets and liabilities such that the net worth of the firm is not greatly harmed when interest rates change. Value at risk, one of the most common measures of risk in finance. It is a way to measure very complex risk all in one number. So given all those jewels in finance, very powerful tools in finance, how does that lead us to this last portion of the discussion, when finance goes wrong? There's so many choices I could have made here, but I like to, when I talk about the fools of finance, I like to bring it back to this one year, 1994. And 1994 is a very important year in finance because between 1980 to 1993, the early 80s through 93, interest rates went from being very high to being dramatically lower. They just pretty much fell through that entire period, except for all of a sudden in 1994, interest rates suddenly shot up. And because of that, the bond market in the U.S. had a very, very difficult year. Well, 1994 is the year that two companies somewhat touched each other. One company, Orange County, went out of business, went insolvent in 1994. And another firm, Long-Term Capital Management, started business in 1994 and then went out of business in 1998. Why would I pick these two examples when there are so many more examples, especially in 2008? Well, I think it's because of the extreme differences in these two firms, and I'll explain that on the next couple of charts. But Orange County is an actual governmental entity in the state of California. It's a county that collects the tax revenues for the county and government offices and then invests it until they actually need to spend it on garbage collection or education. And so while it's being invested, they want to invest it obviously very safely in very low risk investments. And even given that objective, Orange County actually went insolvent in 1994. Orange County was run by a man named Mr. Citron. He was actually an elected official, which is pretty amazing given that he was a Democratic politician running in a very heavily Republican county, and he won with 60% of the vote. He had great success in the 80s and early 90s, pretty much because he took great risk betting that interest rates would continue to fall. And they did. And he had wonderful returns, wonderful performance. And because of his great success for several years, he had a very good performing fund compared to his peers. He became very confident in his abilities to predict where interest rates were going next. And he pretty much kept making the same bet that interest rates were going to fall. And essentially what he did a bull market bet, which with bonds, a bull market bet means you think interest rates are going to fall. So he was going strong into his belief that interest rates were going to fall. When he was questioned about his abilities, you could see his hubris in his response. He said, "I'm one of the largest investors in America. I know these things." Well, really, how can anyone truly know what interest rates are going to do? But because of his hubris, he entered into some very complicated transactions transactions that were well beyond his abilities. This is a man who did not have a college degree, did not have an advanced degree in finance or any business. He was pretty much a learn it yourself on the job training type of investor. And essentially, you ask the question, was he skilled or lucky? You can see this quote from one of his critics is that they saw him more as a gambler who was lucky and won the first few times, and now he's doubling down. The firm CMRA, a very well-known firm, very sophisticated firm, Capital Market Risk Advisors. This is a firm whose job is to come in after disasters such as Orange County, when everything has blown up, and they sit down and try to go through everything to see what they can salvage. And when Leslie Rawl, the head of CMRA, came in and looked at Orange County, she was surprised, given the size of the portfolio and its reputation, how unsophisticated Robert Citron was. And some of the items I mentioned under the jewels of finance, things like duration, convexity, value at risk, he did not use any of those in his analysis. He was pretty much, everything was intuition. I just know these things. I don't need to measure anything. I don't need to model anything. So what does that teach us? Well, it's great that investors, business managers have intuition. They need to have intuition. They need to understand their business. But if that's all we have, just intuition, without any quantification, no measurement, intuition by itself can be disastrous. And a good reason for that is a lot of times what we think is intuition might just be lessons that we learned because we had a few lucky years. We didn't really learn anything. We were just lucky. Or it could be because we have strong biases that we're not aware of. If we don't step back and let there be some good number crunching, some good quantification to see what risk are we really taking, we can really bet the farm and not even realize it until it's too late. Well, that brings us to this next firm, Long-Term Capital Management, an extremely sophisticated firm. This is a hedge fund, a very sophisticated, very private entity that manages money for high wealth, high net worth individuals. And Long-Term Capital Management started in 1994. Very quantitative, the exact opposite of Robert Citron. They had employees making decisions who had 2 MIT degrees, degrees from Ivy League schools, very well respected, extremely quantitative investors, managing risk by the numbers. They felt very, very confident, a lot of hubris, almost invincible, especially because when they started in 94, the first 3 years of their existence, they had incredibly good returns with very little risk. And because of that, they said, wow, look how good we are at investing. They took their models and then started applying them to other areas outside of their expertise. Their expertise was with bonds, but then started trying to use those models with other asset classes, things like Russian debt. Russia had not been a country for that long after the breakup of USSR, but they thought, wow, our model should work with Russian debt, even though we don't have that much history. So what did long-term capital management teach us? A firm that started strong, 3 great years, and then in 1998, complete disaster. Well, those financial tools, quantitative tools, and techniques are very valuable, no question. But if that is all we have, we don't step back and use human judgment and really ask, can we be this confident about our models? Are they really this foolproof? We, again, can be very lethal in our decisions. And I tell my finance students, I'm glad in some ways, I mean, it's not good that Orange County long-term capital management happened, but in some ways it is good news for finance majors. It's good news to know that a Robert Citron with no formal training in finance, doing everything by intuition, that was unsuccessful. The material we're teaching in college finance classes is valuable, can give us great insights into risk and how to manage companies and portfolios. But at the same time, long-term capital management is good news for finance majors because long-term capital management was not managed by finance majors. It was managed by engineers and mathematicians, people who had only quantitative skills but were not trained in behavioral science aspects of finance. If they had been successful, finance might have no longer been a degree plan that anyone would pursue. We would just turn everything over to the mathematicians and their computers, and there would be no need for financial analysis. So you see here the continuum. There needs to be balance. We need to have some critical thinking skills, some ability to be able to step back and just understand that when we're trying to measure risk, trying to measure value, it is a complex, ever-changing process. So I hope this helps in understanding my insights in the essence of finance, that it really comes down to a balancing of value and risk. We need to be very, very, very good at forecasting those cash flows, and then especially important is that we understand the risk that we're taking, so we make sure we're being paid for the risk that we take. Thank you.